Welcome to Microcap Explosions and Classic Value Investors. This is Mariusz Konieczny. Today I'm talking with Robert Bugbee, the CEO of Scorpio Tankers. Robert, thanks for joining me.
Thank you. Thank you very much.
Robert, it's been a few months since we talked, and I think it would be a good time to do an update on what's going on in the oil market, in the tankers. So let's start with, some basic things like, oil demand, the recovery from COVID, and then we'll just go from there.
Sure. So, we're getting a steady increase in demand. Obviously, the United States is really, picking up its demand very fast, and we'd expect that to continue. Europe is, I would say, on the way. There'll be a lot of openings up over the next sort of 6 to 8 weeks, some starting in a couple of weeks. And European vaccinations, after a low start, are really gathering pace. In Asia, it's a little bit mixed, but most importantly, China demand is very steady. The economy is doing well out there, and so what we're seeing is very similar to what OPEC is seeing, the IEA is seeing. Most major oil analysts are, continuing to see this steady increase in petroleum products demand over the next months to come.
Okay, and there was obviously a positive development in the stock prices of both product tankers and oil tankers. Is it because of the anticipation of what's coming, or is it already reflected in charter rates?
I think that the actual forward market in terms of time charter rates is in a very positive contango. We've seen a number of charters just in the last 2 weeks from oil majors and traders for all types of product tankers, really from 1 to 3 years. All are significantly higher than today's present spot market. We're also seeing a very strong asset price market, especially for modern vessels that are in the water. That's coming as a combination of increased charter rates, anticipation, very strong yard pricing. There's very little capacity if you wanted to order a product tanker. The order book is at a record low. So in a way, the stock prices might be anticipating a increase in rates, but in other measures, they're still way behind. I mean, they're way behind the. If we take Scorpio Tankers, for example, and I'm sure it would be the same for the others, the increase in value of the vessels has, far exceeded in the asset value terms the development of the stock prices. And so, the Scorpio Tankers is trading at a steep discount to NAV in a rising freight environment, and I think that creates a lot of opportunity for investors at the moment.
So what you're saying is that the underlying asset values increased much faster than the stock prices.
Correct, and then that's also a function of gearing, because a company like Scorpio Tankers, if you have a 10% increase in underlying asset values, that's leading in its early stages to a 35% increase in underlying, net asset value.
I see. And can we talk a little bit about the floating storage? Because as you know, during the COVID situation,
Sure,
a lot of the floating storage got filled up. And where are we in the process of working through that?
I think we're worked off now. I mean, we had a peak in the product market of about 106 million barrels back in the end of May 2020. And now we're down to 22.8 million barrels, which is pretty normal at the moment. In some senses, that's normal over a 5-year trailing level, excluding 2020. So as demand starts to pick up towards the end of the year, it's very quickly you're turning to let's say negative inventory positions. So I think the inventory position is very healthy, both in floating and onshore storage. Particularly when we look that we're coming up to the driving season, the big heavy gasoline season for the northern hemisphere. Inventories are, from a shipping perspective, are looking very healthy now.
And when you talk about inventories, do you only specifically mean the product inventories, or do you mean both product and crude inventories?
My previous statement was to the product inventories themselves. That's a little bit more, more advanced. For example, you can't store jet fuel, so jet fuel there's almost no inventories at all on board vessels any longer. Crude is slightly behind. But again, they've made tremendous headroads into drawing down their inventories too. So, at present deficits, it's hard to tell. Maybe the crude inventories are 30 to 40 days, behind the product inventories. But it's so easy to draw down crude inventories once they get to this level anyway.
I remember when we were talking about before. The oil demand, pre-COVID, the oil demand was about 100 million barrels per day,
yeah.
And then we were somewhere around 95, and we needed like jet demand to complete that picture. So I was wondering if you can talk about where we are with the oil demand right now and where the jet fuel demand is.
Well, I think that we're, I think if I might start with where we are in refinery turnarounds, we're just coming out of a very steep refinery turnaround period for April, and it decreased slightly in May, but it's going to, it was up at 11, 12 million barrels per day at its peak, and that's falling rapidly to about only 5 million by the end of June. So, we're going to be picking up, let's say, 6 million or so total barrels of crude oil demand through the year now, and that's even if we keep present inventories neutral. For the product market itself, I think what's even more exciting is that 100 million barrels of headline crude oil demand today is worth much more in ton miles in demand for the product market than it was yesterday. And that's because we've seen a number of closures of refineries that are closer to the consumer being replaced by newer refinery exports, such as the Middle East, which is a long way away from the consumer. So even if we get back to 100 million barrels a day of demand by the end of the year, it will still be a significantly higher, that 100 million barrels in terms of product tanker demand will be worth more than 100 million barrels a day 2 years ago.
Interesting. There was a significant refinery maintenance from March through May.
Yeah.
Can you talk about this? Like if it's still going on and how it impacts the market?
Sure. So, there was 12 million barrels of maintenance in April, 10 million in May, and this is dropping to about 5 million for June. So, in simple terms, we're going to, this month, and this is why, many of us on the trading floors of the product markets think this month is an inflection point for products, is because that's a steep change to have a 5 million barrel a day change in refinery utilization between May, end of May and the end of June is a pretty steep change, and that combined with what we would expect more jet fuel usage across the world as we move through June into July. That should create an inflection point for the rate structures.
Yeah. Okay. And
I think that's why these oil companies and traders have been going in and taking vessels in on time charter, quite heavily now in this last 2 weeks.
Okay. The recent Suez Canal blockage, in the short term, it obviously had a big impact on the tanker market. Do you see any differences from what happened there, or was it just a short term thing, or it has more of a
No,
medium?
I think these things just show the like many other things that are going on in the world, whether it's delays in ports or or we'll soon have hurricanes. We're soon going to be going into the hurricane season soon in the Western Hemisphere. Just show how tight the supply chain is. Whether it's delays in dry cargo, whether it's container ports in California, having lots of ships piled up for waiting, whether it's the Suez Canal changing, whether tomorrow it could be a refinery outage or a hurricane. We have a very, very tight supply chain at the moment. So any short-term sort of blip is going to create some opportunity for rates to go up. Now that's going to increase as the demand increases. I mean, those things were happening on markets where the world was still opening up. Imagine if you have these dislocations, 2-3 months forward, when we expect the base demand in tankers to be so much stronger and the markets to be in so much better utilization anyway. So I think that we should just take those for what they are, which is nice little things to have, but they don't change the overall, fundamentals going forward.
And
Go
ahead.
I was saying this is very much, in our minds, turning into a very strong long-term, opportunity and value, in the sense that the fundamentals going forward are so strong for multi-years.
Yeah, and talking about the long-term thesis of the market, we touched upon a little bit on the order book, but considering the fact that now market participants see brighter future for the market, how do you see the order books staying low, or do you expect it to increase?
I think that's a great question. And I think this is one of the real opportunities. We've so far been facing, demand itself. And so if we do turn to this order book and supply, look, there's one of the reasons the order book's staying low is because there's such uncertainty about the correct propulsion system that you should use going forward. It's not really just the engine type either, but the supporting infrastructure. If, for example, you were to go dual fuel LNG on an MR tanker that was to trade in Latin America, how can you be sure that you're going to get LNG fuel as bunkers? The order book itself is literally at an all-time low since data was kept, and the product fleet itself is aging. Many vessels are turning 15 years old, which will remove them from the premium trades in the clean petroleum market. And another thing that's so important is that of course, ship owners historically, once they've got a little bit of money in their pocket, have immediately started to order. We're seeing that in container market. We're seeing that in dry market. One of the great things about the product market right now is that the yards are so full up going forward with all these orders from gas or from dry cargo or containers that, I'm sorry to say it, but it's what it is. It's almost impossible for us owners in the product market to screw this up for a considerable time, because we just can't get, berth space for 2.5, 3 years.
Well, that's interesting because I didn't think about it. I know that the containers and dry bulk have been on a tear, but I didn't think of it in a way that because of the success in the other sectors, the building capacity is restrained.
Yeah, so in a weird way, we're sort of, it's not unusual in the two big mega cycles before, the 1980s and the early 2000s, the containers and the dry led the recovery, followed by products, followed by crude. And, one of the things that we're having today is this delayed gratification is helping set up a fantastic position in the lack of yard capacity for products. And the other thing that's important is that yard capacity itself is probably going to be much more constrained than in the 80s or the 2000s. In the 1980s, we had the growth of Korea. Beginning of the mid-1980s, Korea were nowhere. It ended the 1980s, the largest shipbuilder in the world. In the 2000s, China was nowhere at the beginning of the 2000s. It ended the 2000s, the largest shipbuilder in the world. There is no emerging new building nation right now in the world. So we're kind of going with what we've got right now, which is being consolidating. And Korea and China have become richer countries. Chinese real estate is by the sea is much more expensive now. Another thing that's happening is the production. We sped production up tremendously in the 1980s by the use of robots. In the 2000s, we sped production up by the invention of block building for ships, which meant that the blocks could be built away from the shipyard, brought in, and the vessels assembled at the shipyard. Again, there's nothing really on the horizon that's going to materially change the production time of a vessel. So here, now it really does matter if we have a shipyard and berth capacity taken up at the front ahead of a product market recovery like it's happening now.
And what about scrapping? I mean, times last 12 months haven't been too great for the rates. So I was wondering if any scrapping happened, enough scrapping. What's your view on that?
Yeah, I think that a couple of things. So, first of all, in the product market, as we've talked about before, we're not really that concerned in scrapping. It's more when a ship earns 15 years old. But it's always nice to see scrapping in tankers and in the crude side. And you have to remember that even though the stock prices last year anticipated the collapse in rates, the actual rates themselves, these companies generated a lot of cash. And so there has not been any pressure on somebody to scrap a tanker, even though the rates have been weak. And frankly, with scrap prices just going up and up on the basis of steel, they've done the right economic thing in the last few months, which is to take whatever they can get in the market, even though it's poor, and just have an asset in their scrap value that's been going up and up and up. And that there's indications that those vessels, the calculation's different now. If you're going to put a ship through a fourth special survey, for example, and face heavy maintenance costs, then you might take the position of, well, scrap price has gone up a hell of a lot now. I'm going to move to scrap. So now you're likely to see scrapping increase even with rates increasing.
Okay. And can we move on maybe to more specific questions about Scorpio Tankers and how's the company positioned, maybe some capital allocating decisions now
Sure.
that,
So, we think we've positioned pretty well for what's to come. We have all of our vessels are in the water. We've dry docked in the last 18 months about 75% of the vessels. We've almost completed putting our scrubbers on the vessels. So we have very little CapEx going forward and very little downtime. So, and in addition to that, we have all of the vessels are in the spot market. So we have a situation where we're naturally very leveraged now to the improvement of that market because all of our vessels are spot, so we'll capture the increase. We don't have much downtime, so we'll be able to keep our vessels out on the water earning money. And we've already spent most of our CapEx, which means that as soon as those rates come in, that value, that earnings are going to come straight to us as shareholders. We have said that, we will, we start returning capital and, paying down debt at, about, less than where the rates are today, around 11,000 a day. And we will, once we get to around 17 and a half a day, we'd already be paying off pretty close to $6 a share in debt. And above that level, we've said openly consider, doing stock buybacks, etc.
Yeah, I remember you were talking about this previously, that when the company would be ready, you wouldn't be opposed to doing this buyback.
No, it all depends where the value of the company is. I mean, if we continue to have this steep discounts, then that's a different situation.
So if Scorpio Tankers were to trade at NAV, where would the stock price be?
We don't give exact numbers, but we said three weeks ago that anyone doing an NAV would have to have a value that's well in excess of $25, and the actual oil prices have gone up since this last 3-4 weeks. So that's why I refer to you should be coming pretty close now to 30 plus. So that's why I refer to a very steep discount.
Mm-hmm. Okay, and then final, you used to run Scorpio Bulkers, and now the name of the company is Eneti. Can you talk a little bit about it? I know that you sold some ships. I'm not sure if you exited it completely, but just kind of give us an update on what's going on that side.
Sure. Well, we've used the strength of the dry cargo to really exit the dry cargo market. We've nearly done it. Probably will be out entirely, let's say, by the end of June, July. And what we're going to be focusing on is renewables, and the area we'll focus on is the offshore wind installation vessels. These are very high spec, vessels that will literally work offshore and will install the wind turbines for the increasing demand for electricity created by wind going forward. And there are, a number of movements across the world, whether it's Europe, Asia. You're going to read more and more about it in the United States, particularly when the United States, government puts through its infrastructure or green plans. And we think the growth for that is, the growth figures for that and opportunity are tremendous. And that's, it's really a work in progress. There's nothing more that we would, wish to say at the moment, but we're ideally placed as the only U.S. stock exchange company with offices over here to partake in the, U.S. Growth. And we obviously have a lot of building experience in Korea, which makes the best international wind installation vessels.
Okay, perfect. Is there anything else that you would like to add before we wrap this up?
No, I would just say that we're in a very, not really for Scorpio Tankers, other than we're in a very exciting part of shipping. This really could be a super cycle in shipping in general, not to mention product tankers, very similar to the 80s and the 2000s, because we've got all the ingredients required for that: steep world growth, recovery on the demand side, governments wanting to pump money into infrastructure and commodity projects, and they're all going to have to compete for yard positions. And whenever you have a situation where yard pricing is going upwards because there's demand for ships in general, and you have, let's say, some form of inflation with let's say, a dollar that is not as strong as it's been in the decade before, those ingredients of inflation underlying asset values really starts to create confidence in the capital bases of these companies, and helps create great returns.
Okay. Thank you very much for the nice summary, and thank you for the interview, and have a good day.
Thank you.